Welcome to DIY Finance Guy. I'm Sergei Modilevski, and today we're talking about another scenario from the Bank of Canada about how mortgage payments might jump by up to 45% by 2025-2026. Leave me a comment down below and let me know your thoughts. Will mortgage rates be higher or lower by 2025-2026? In this video, we'll discuss the cause of spiking consumer prices, the impact on mortgage rates, and how long this period of high rates may last. We'll also discuss the direction home prices may take in the near term. The Bank of Canada advised that some Canadians who took out mortgages in 2020, 2021 could see their monthly payments jump by as much as 45% when their mortgages renew in 2025, 2026 at the end of their 5-year terms. This scenario would affect every homeowner, whether they hold a fixed or a variable rate mortgage, because by that point their mortgage terms will have expired and they'll be up for renewal. But growth in their income and productivity in the economy may help offset a lot of those additional costs in the future. Let's look at an example using my friends Martha and John. They took a $500,000 mortgage and had a household income of $120,000. They placed a 20% down payment at the time of purchase. So according to the Bank of Canada, their housing payment would be 30% more when their mortgage matures in 2025-2026. When they first took a mortgage at a rate of 2.04, their payment of $1,858.11 accounted for 19% of their gross household income. Over those 5 years, Martha and John saw their income increase an average of 2% per year. Based on the last 40 years, this has been the average increase in Canadian wages. At the time of their mortgage maturity, their income has increased to $132,490. That means that even though the housing payments are 30% higher, it makes up only 22% of their gross household income. This is 3% more of their gross household income than would have been allocated towards their housing payment in the past. Based on a split household income of $132,490, we can assume that would consume around 5% more of their household budget. The scenario from the Bank of Canada assumes that interest rates will remain at current levels even 5 years from now. That's entirely possible, and they may even be higher, but that reality is far from certain. As interest rates have risen this year, a lot of economic slack has been absorbed as asset prices fall, saving rates decline, and business inventories build. Conditions in the labor market are strong, but overall global GDP is slowed. The World Bank expects global GDP to slump from 5.7% in 2021 to 2.9% in 2022, significantly lower than the 4.1% anticipated in January. It's expected to hover around that pace over 2023-2024 as the war in Ukraine disrupts activity, investment, and trade in the near term, pent-up demand fades, and fiscal and monetary policy accommodation is withdrawn. Energy, commodity, and most notably food prices are driving most of the inflation that we're seeing in consumer price readings. According to Statistics Canada, the recent period of higher food prices has occurred within the context of numerous events continuing to fuel higher prices. With both countries being major wheat exporters, Russia's invasion of Ukraine in late February put upward price pressure on food products that use wheat. Poor weather in growing regions has also impacted prices for food. Additionally, higher prices for inputs like fertilizer and natural gas have made the cost of farming more expensive, and farmers are now passing on those prices to consumers. Shanghai's 2-month lockdown, the shuttering of many malls and venues across Beijing, as well as the movement curbs imposed in many other Chinese cities in recent months have heavily battered the Chinese economy, disrupted supply chains, and slowed international trade. These two events have compounded inflationary pressures, leading to the inflation rates that we're dealing with today. The fallout is reflected in falling home prices and falling economic activity. Toronto home prices have fallen for a 4th consecutive month in June, down by 14% from the peak of more than 1.3 million reached in February. The Toronto Regional Real Estate Board said 6,474 homes were sold in the Greater Toronto Area last month, down by 41% compared with last June. According to TREB President Kevin Krieger, home sales have been impacted by both the affordability challenge presented by mortgage rate hikes and the psychological effect wherein homebuyers who can afford higher borrowing costs have put their decision on hold to see where home prices end up. Expect current market conditions to remain in place during the slower summer months. Prices may fall further as the market absorbs several headwinds. High commodity prices, recent lockdowns in Shanghai, and the ongoing war in Ukraine are likely to lead to higher CPI readings over the next few months. In addition, any low-rate rate holds that borrowers had from February are now expiring, and any new home buyer will be qualifying at 5-year fixed rates that are more closer to 5% or even a little bit higher. Lastly, consumer confidence is likely to remain very low as the Bank of Canada prepares another oversized rate hike for their meeting on July 13th. If we see a negotiated ceasefire in Ukraine and avoid lockdowns in parts of China, then interest rates will likely come down and home prices will stabilize quickly. Until we see those indications, mortgage rates will likely remain elevated to curb consumer spend during this period of supply chain disruption. If you'd like to get pre-approved for a mortgage or discuss a refinance, you could book time with me and my team by using the calendar link in the description below. If you're still watching this video, then you must like this sort of content. Please hit the thumbs up and subscribe for more real estate and investing content. Thanks for tuning in, and I'll see you in the next video.